MACD. This is yet another indicator that I believe is worth your time. Let's discuss what the MACD is all about. The first two letters MA stand for M, moving, and A, average. Okay? And the C in blue then stands for Convergence. And the D stands for Divergence. Okay, so the MACD, or the moving average convergence divergence, does three jobs. One of its jobs is to indicate the average movement of the market. The second job is to identify when the market is converging, and convergence just simply means if you look at two lines, they'll be coming towards one another, so they're about to meet somewhere. So this is a point of convergence. Or it can indicate divergence, and divergence simply means that if one line is going the other way, the other one is going in the opposite directions. So these two lines will never touch, from a central point and diverging outwards. Okay, so convergence coming towards a single point, divergence moving away from a single point, and obviously moving average. So this indicator does three jobs all in one. That's why I think it's so nice to understand how this one works. Let's look at some examples and basically get deeper into the subject. So down here, we've got a market that's moving downwards, which simply means that it's creating highs and lows. But the highs are going lower, so we've got lower highs and lower lows. And we've got a lower high, and here we've got a lower low. So in general, this market is moving downwards. Okay? So in essence, if we connect all the lows together, let me do that for you. So if we connect those lows together, we're going to have an arrow that's actually pointing downwards. But if we look down here, this is your MACD. If you look at the MACD, as we create our first low, the MACD also creates a low here in blue. As we create our second low, the MACD also creates a low here in blue. But instead of the low becoming a lower low, it's now a higher low. So this is the low, this is the higher low. And the third low, which is supposed to be a lower low, becomes a higher low. Alright, so it's literally doing the opposite of what the actual price is doing. So here the MACD is indicating that the market is moving upwards. Alright, so the price versus the MACD are not agreeing. As a matter of fact, they're trying to meet somewhere at a single point. So at this point, the market is doing what? It's converging. So this is what convergence looks like. Okay, so what's happening here on the right is literally the opposite of what just happened here. So in this case, the market is going upwards, right, which simply means we're creating a low, and then we create a high, and then we create a higher low and a higher high, then we create a higher low, and we create a higher high. So that says that the market is going upwards. And as we're creating these highs, if we connect them like this, we can realize that the general direction of the market here is moving upwards. So price is moving up. But if we look at the MACD down here, as we create this high, and as we create the second high, the high is no longer going higher than it's supposed to be. It's now creating a lower high. And when we create the third high, which is now a higher high, the MACD creates a lower high. So in essence here, the MACD is saying that the market is moving downwards, so it's losing momentum. And what you're seeing here is what we spoke about, the market moving away from a single point and going in different directions, and this is known as your divergence. Okay, so in this case the market is diverging. So this is how divergence looks. So in essence, what we're predicting is that when the market is moving downwards, like it is here, we expect that as the MACD loses momentum, because this is what it's indicating, it's losing momentum, and after momentum is lost, we expect the market will then shoot out in the opposite direction and start creating an upward trend. So we are expecting the market to reverse, take a U-turn from this point onwards, going upwards. The same goes to the upward trend that's also losing momentum because of divergence. As the market is building up, the MACD is losing momentum, it's getting weaker and weaker. So what we're expecting there is that the market at one point will then break out of this uptrend and start moving downwards and create new lows and become a downward moving trend. So basically in an uptrend, we expect that this lows will be broken and this trend will stop moving upwards. Alright, so this really helps us predict where the possible breakout will happen. The same thing applies to the downtrend. If we connect the highs in a downward trend, we expect that because of convergence, the market will then break out here and start creating an upward trend from there. So we literally use convergence and divergence to predict when the market is about to change in direction from a downward moving trend to an upward, or from an upward moving trend to a downward moving trend. So let's look at it. Let's look at an example down here. So if we're speaking about actual real charts, this is how it would look. Okay, so the market is coming down here, it creates a low here. Okay, it tries to take the market up, finds some resistance up here and continues going down and touches here and creates the next low. So this is the lower low. The market then tries to move upwards, finds another resistance here and continues going lower, and then down here creates a lower low. So it's right here. Okay, so in essence the price action is moving downwards. Right, but if we look down here at the MACD, as this guy was creating a low, the MACD was also creating a low. Okay, when we created our second low, the MACD also created a low, but this low was now a higher low than the previous one. It then created a third low, which is about somewhere there, but this low was also a higher low. Okay, so in essence, this is how convergence looks like. Okay, so what is this? The market here is converging. Okay, coming together to one place. So obviously this is trying to say to us, listen, these boys are running out of energy, they're running out of momentum, and we might see a reversal in trend. So as the market then starts moving out of that area, we can then start identifying or trying to buy from this level onwards, because this is the lowest point we've been before the market was excited by a opportunity to buy, because it was selling all along, and according to the MACD, the sellers have lost momentum. And when you lose momentum, who do you lose it to as a seller? You lose it to your buyers. Alright, so let me zoom out so you can see what really happened. So basically the market struggled a bit, but finally bought out of that price here at this point, where the market then just started going upwards from there on. Okay, and that's how we use the MACD for convergence or divergence. Divergence would be literally the opposite of convergence. Okay. Another way that we said we could use the MACD is by the moving average. Okay, so if we look at this current MACD here, you see, or you'll notice a red line moving through the histograms. Okay, so here's this red line that I'm talking about, and the red line then starts moving up, then starts moving down, and so on. That's what we're going to be talking about. So let's scroll down and get our own red line. Right, so as the MACD is creating these histograms, these lines that it's creating, there's an actual moving average that's moving along those histograms. So while it's like this, it's showing you that the momentum is upwards. So because the histograms are appearing above the moving average, it means the price is above average in terms of strength. And since we are above the 0 point, okay, so this line here is 0. Anything above the 0 is a bull. So this is showing us the momentum of the bulls. Anything below 0, so all these histograms down here, these are all representing your bears. Okay, so when you see histograms below 0, you know the bears are in control. If you see histograms above the 0, it means the buyers or the bulls are in control. So while this is happening, this means the bulls are still extremely strong. So I'm going to hold it there. So for as long as the red line is below the histograms, this indicates strong bulls. All right. Then as soon as that moving average leaves the histograms and the space, what color can we use for this? I think green or light green would be beautiful. Yeah, this green here. So as soon as we see space between the histogram and the moving average, this then is a signal that indicates that the bulls are now weak. Alright, so this serves us as a sell signal. Okay, so we'll be expecting to start selling as soon as we see this happening, because then that's an opportunity to sell. So obviously the moving average will continue and get to a point where now it's moving back upwards. So at this point again, because now the histograms are above the red line, it means that the bulls are strong. At this point, it means now the space between the histogram and the red line, which then gives us another sell signal. Okay, so again here, sell. Alright, then the red line will continue moving above the histograms and finally going through the histograms, giving us another sell signal. So as soon as the space in between the histogram and the moving average, we've got a sell signal. Okay, so the opposite happens as the moving average is moving down here, for instance. So as it's here before moving out here, this is an indication that we have strong, no, strong bears. And so the sellers are in control here, and as soon as that moving average leaves the histograms and goes above them or below them, actually in this case, and we can see that space between the histogram and the moving average, we know that now we've got a market with weak base, right? Which basically opens doors for buying opportunities. So as soon as this happens here, we start looking for a buy. Okay, So let's let it continue. So it goes on, and finally goes back into the histogram, showing that we've got strong bears, and then it leaves the histogram again, creating that space here that we're looking for, which indicates that at this point we've got weak bears, which invites buying opportunities. Alright, so it goes on and on. So still buying opportunities. Then the sellers come in again, showing us their strength, and then they lose power again here, where you now have space between the histogram and the moving average line, which again gives us a buy signal right over there. And that's what it literally means. So you can use it in one of three ways. So this was way number one. Up here we had way number two and way number three as divergence. So let's take an example with the signal line. So obviously the MACD here is above 0, which means these are all buying opportunities, or in essence selling opportunities, because we've got strong, not dark enough. Here we've got strong bulls. So we're looking for sellers that are willing to challenge these bulls. So what we see here is the space that I was referring to that's created between the moving average and the histograms. Okay, in this area we're expecting that there are weak bulls and that we are able to start selling. All right, so let's look at it. So upon this candle closing here, so this is the closing price, we expected the market will start moving down, which it did for about 1, 2, 3, 4 candlesticks before moving upwards. The second time that happened, the market then did the exact same thing. The red line left the histogram, started creating space, and this space went for a while, as you can see, before going back and the histograms above the actual moving average. So upon this price here closing, we started seeing the market sell from that area. Okay, so the market went downwards. Number three, again, the histograms went below the moving average, giving us this small space here, showing us that we have weak bulls here, so there's an opportunity for us to sell there. So we would have also sold upon this candle closing, start selling from this point, which it didn't go far enough. It went a bit down, but in general went upwards. Let's look at the last example here. So again here, same thing, the moving average was running through the histograms, and now the histograms are officially below the moving average, right? Which simply means now the market here has a weak bull and potentially can give us a nice opportunity to sell. So we started selling this candle upon closing, so the closing price of this candle, we started selling from there. We can see the market then reacted very well and started going downwards. So that's the third way, or in essence the first way of using the MACD with the signal line. Okay, so those are the three ways. We looked at the moving average, tick, we looked at convergence, we looked at how divergence can also work for you. So let me know if you loved how I explained the MACD. If you think I forgot anything, also drop those in the comments. Until we meet in the next video, peace.